Hey everybody, Tim Ulbrich here alongside Tim Baker, and welcome to this week's segment of the Rx Money Roundup on the YFP podcast, where we give you our take on relevant financial news and updates, answer your questions, and break down examples of financial planning in action. Today, we're going to be talking about how an expected September interest rate cut from the Fed may impact you. But before we do that, let me give a shout out to our financial planning and tax professionals at YFP that make this segment possible. At YFP, we support pharmacists at every stage of their careers to take control of their finances, reach their financial goals, and build wealth through comprehensive fee-only financial planning and tax planning. You can learn more and book a free discovery call by visiting yourfinancialpharmacist.com. All right, this week, Tim Baker, lots of discussion going on as we're expecting, although I feel like we've said this before, we're expecting a interest rate cut from the Fed. It looks like all signs are pointing in that direction. And I think while so much of the news has been focused on that, the consumer is probably thinking, how does this actually impact me? What does this mean for my day-to-day financial life? So whether it happens, whether it doesn't, when we hear the Fed talking about interest rate cuts, what is the impact of that to the consumer? What are some of the things that they should be thinking about?
Yeah, so in broad strokes, Tim, I would say, good for the borrower, not so good for the saver. Um, so I think if we kind of break this down, from a borrowing perspective, lower interest rates on loans. So this kind of has a cascading effect from the Fed all through, various markets. So if you have things like variable rate loans, because this could be student loans, it could be HELOCs, home equity line of credit. It could be a car note. A rate cut could lower the interest rate on these loans because they basically are pegged to the market and what the Fed is doing, which essentially means that you could have reduced monthly payments, which is always a good thing. The other thing that basically affects the borrower is any new loans, cheaper new loans. So if you're planning to take out a new loan, such as a mortgage, a car note, a personal loan, the interest rates will be lower. So that means less expensive, payments for, whatever you're buying. And I think like one of the things that, I've seen or I've heard is, and this is true for us, Tim, is like because our home is kind of south of a 3%, we're like, I don't think we're never going to move. So we really want to put money into the house that we have. However, if we don't necessarily have the cash and we're using something like a line of credit, it does give you pause if your rate is in 7, 8, 9% or whatever that is. It makes those projects even more expensive. But I think like if the rate comes down, it makes it a little bit more palatable. From the housing market, obviously cheaper mortgage rates. So if you're looking to buy a home or refinance an existing mortgage, it becomes better in that regard. A rate cut could lower the mortgage rates and make home ownership more affordable. It could also affect home prices. So lower mortgage rates can boost demand for housing, but can then potentially drive up the price of houses because there is more demand on the buy side. From the savings and investment perspective, this is where you typically see lower savings account yield. So I would always get jacked up that, my Ally account would go up from X% to Y%. And I'm like, awesome. And now we're going to be, probably riding the slide down. So, we'll see high yield savings accounts, money markets, CDs decrease. All the more reason I think to have the cash reserves that you need, but no more. Get that money into the market and let it do its thing. Bond prices. So on the investment side, bond prices typically rise when interest rates fall because existing bonds with higher interest rates become more valuable. So if you have bonds or bond funds, they might increase in value. Stock market too. Lower interest rates often encourage more investment in stocks. So this could be good for the stock market as well. Typically, cuts in interest rates signal the stock market. The stock market is very fickle, but it'll typically have a positive impact on the price of stocks. Things like inflation, so cost of goods and services, lower interest rates can stimulate economic activity, which might increase demand for goods and services, which could lead to higher inflation. So that's one of the things that they're trying to really balance here. And often just overall from a macro perspective, cut in interest rates typically can stimulate growth. So that's kind of what the game that they're playing is, when to cut and how much and to kind of keep the economy growing while combating inflation on the back end. So, To the day to day, I think, again, looking at it very broadly, from a borrower perspective, good, especially if there's variable things or you're kind of entering the market. From a saving and investment perspective, saving maybe not so good, but investment could be good depending on, what type of investment you're doing and your approach. So, I think that would be the big effects on the consumer from a day to day. It could trickle down, like I said, to some of the costs and goods and services that we talked about in our previous roundup and the effects there. But I think I'm interested to see where this goes. Again, we've been talking about this for a while. All signs point to this happening in September.
Mhm.
Not sure when we're going to publish this, but there could be one cut this year. There could be three cuts this year. It just depends
Mhm.
on who you're talking to. But I think that is the posturing that the Fed is taking right now, that there will be a cut imminent.
Yeah, and the markets have been reacting, right? A lot of conjecture,
That's
going
right.
on. And so if you've been following along, and perhaps maybe many of you are more passive in your investing approach, if you listen to the show, and maybe you were asleep for the last month and didn't notice a whole lot of change from the beginning to the end. But if you've been checking daily, there's been a lot of swings going on, in part based on what they think the Fed is going to do, should have done, will do going in the future. So more to watch certainly there in terms of the market reaction. Tim, the other thing I'm thinking about here when you talk about the borrower, student loans are an interesting one, right? Because on the federal side, those interest rates are determined each spring for new direct loans for the following year. And that runs from July 1 to June 30th. And that is a fixed interest rate for the life of the loan. Let's remember that, right? So now, if you refinance those federal loans, that will be something interesting. Do we see refinance, whether it be on the mortgage side or the student loan side? If we see a tick down in rates, perhaps we start to see some of that come back. But especially for newer borrowers, or even those that, are in school and maybe listening, these rates for next year, Tim, check this out. Direct subsidized loans and direct unsubsidized, 6.53. Direct unsubsidized on the graduate or professional side, pharmacy school, 8.08. And
Yeah.
direct plus loans, parents, graduate, professional students, 9.08. Those are fixed for the life of the loan, right? So even if we see some of these cuts, like, there's going to be some interesting decisions to be made. I'm thinking about maybe the pharmacy student who's, next year going to have these higher interest rates, and then coming out in 4 years, depending on where interest rates are at in the economy, like, we might see refinance come back into the future.
Yeah. Like I said, and you just alluded to it, we've kind of seen this before where, from a federal perspective, I always said, and I think we've had to tick this up. Like, I've always said, anything around or less than 6% on a federal loan is pretty good. Now these new loans are going to be higher. So, we would look at the client situation and say, okay, if there's a forgiveness strategy we're doing on, that we set that aside, but then you're trying to say, okay, is there enough delta between what the market will give me in the refi
That's
market
right.
to what the federal is? So, back in the day, we would see some, especially 5-year variable where they would be like 2% or less.
Just back,
So,
and when you say back in the day, you're talking like 2020.
yeah, was it was
Yeah.
it was it that was that recent 20? Maybe, yeah,
Probably
maybe
it was
right.
like right
Yeah, yeah.
before the pandemic.
Seems like a
Yeah.
lifetime ago.
Yep.
But yeah, like so I think that will come back where we're gonna be issuing these loans at 7, 8.5, 9%, whatever it is, and then we're gonna come out, and depending on kind of the career trajectory and the strategy we're using, we're gonna say, hey, we're paying 8.5%. The market has come down where now you can get a refi at 5%, 4%. And I think that, obviously you give up some of the safeguards in the federal system that you don't have necessarily in the
Yeah.
private system, although that market is trying to compete. So I think that will make it a little bit more palatable, where those have really dried up in the last, I guess, 4 or 5 years, where we haven't really seen a whole lot of refi. So yeah, that is another effect of the rates, moving.
And the reason I bring that up is we're in a presidential election year, and there's a lot of posturing going on around student loan debt. And so we'll see what actually shakes out, what doesn't. But if rates are at this level, it makes things like public service loan forgiveness programs all the more valuable to potentially pursue, right? Because
Yes.
in those strategies, again, we're maximizing tax free forgiveness, trying to minimize out of pocket payments. So lot to watch here as we progress into the future, but great overview, Tim, of what the potential impact may be on the consumer. If you have a question that you would like for us to answer on an upcoming episode of the Rx Money Roundup segment of the podcast, send us an email, info@yourfinancialpharmacist.com. You can also record your question by visiting yourfinancialpharmacist.com/ask. As a reminder, anything that we talk about, the content on this show is for informational purposes only, not intended to provide, should not be relied on for investment or any other advice. Information on the podcast and corresponding material should not be construed as a solicitation or offer to buy or sell any investment or related financial products. For more information on that, you can visit yourfinancialpharmacist.com/disclaimer. Thanks so much for listening and have a great rest of your week.